In a 2006 Columbia Business School lecture, legendary investor Li Lu gave away his entire investing process by revealing 2 investments he's made in the past with incredible depth. You can find the lecture on YouTube, but there are handouts he gave to the students that are impossible to find. If you had these handouts, it'd give you the ability to learn in real time from an investor so wonderful that he's been crowned the title of the Chinese Warren Buffett by Charlie Munger himself. And I might have found those handouts. But wait, before I give them to you, I need to say something extremely important. You only get the experience of having the handouts and trying to keep up with Li Lu one time. You only got one shot at this. That's it. This is a once in a lifetime invaluable opportunity. In a minute, I'm going to break down the Columbia Business Lecture, add in bonus content, and completely disrupt what people think about this lecture. But I don't want to ruin that experience for you. If you're not feeling up to the challenge yet, I highly recommend you save this video and revisit it at another time, even if it's years later when you're feeling up to the challenge. So if you're still watching this video now, I'm going to assume that you want to torture yourself and put yourself in the hot seat at Columbia. So here's what you're going to need to do. First, go into the description of this video and find the links I labeled Timberland Value Line, Hyundai Department Store H&S, Bloomberg 005440, and BLOOMBERGTBL. Second, print these out, have them open on a computer, whatever you think you need to do to follow along with the lecture. Third, find the link to the full lecture also in the description of this video. And lastly, pause this video now and watch the full lecture with the material in hand and see if you can not only keep up, but find exactly what he's talking about in the material. Be very honest with yourself. Pause this video now and we'll leave the list up for 10 seconds just in case. If you're still watching the video at this point, I'm going to assume that you get to experience Li Lu's lecture in its full effect. Let us know in the comment section what you thought. Were you like, it's simple?
It's simple.
Or did you also get humbled enough like I did to merit some of those YouTube comments blasting those students? Regardless, let's now walk through Li Lu's investing process using his examples, add in some bonus content, and expose Li Lu's biggest secret that nobody knows about, and I'm going to reveal for the first time ever. To find new opportunities, Li Lu will read manuals that list business after business. He'll read every value line report as soon as it comes out, which is every Monday at 8 a.m. Eastern. The things that initially jump out at him when he's reading these manuals are the stocks on the new lows list. For example, the ones with the lowest price to earnings ratio, or the ones with the lowest price to book ratio. Assumedly, this is how he stumbled across Timberland in fall of 1998. To figure out the price to earnings ratio is pretty simple because Value Line provides it to us at the top. To figure out the price to book ratio involves one more step, and it's made a little bit more complicated because Li Lu gives us an extra detail. So to figure out price to book ratio, you need to take the price and divide it by the book value per share. Makes sense, right? But Li Lu provides 2 price ranges. He said when he was buying Timberland stock, it was between $28 and $30. And as of this report, which came later, the price was $46. So we'll do both examples so you can understand both cases. We take the prices and divide it by the book value per share, which is roughly 20, and we'll get that price to book ratio of 1.5 when he was buying and about 2 when this report was made. Hold on before we say whether 1.5 or 2 of a price to book ratio is good or not, because Li Lu implores us to ask what makes up the book value. According to Value Line, Timberland's book value was around $275 million, which Li Lu just rounds up to $300 million to keep it easy and simple, and because, what's another $25 million to do, right? So of that $300 million, Li Lu is determined that $100 million is in cash, $100 million is in liquid assets, and $100 million is in fixed assets. How he got those numbers is pretty complicated, but we'll do our best to explain it in a way that's so easy a caveman could understand. To figure out Timberland's book value, we have to understand how a balance sheet works. A company's balance sheet is broken up into short-term assets, long-term assets, short-term debt, and long-term debt. But people in finance like to get really fancy and call things by different names. So another way of saying short-term is by using the word current. And if we take current assets and subtract current debt, we'll get working capital. Long-term debt we can keep the same, but instead of saying long-term assets, we'll use the term fixed assets. So essentially, instead of using this as our balance sheet, we'll use this. Now we can walk through what Timberland's book value is step by step by figuring out the working capital, the long-term debt, and then the fixed assets. Okay, so to figure out the book value, let's first start with the working capital. To figure out the working capital, we're going to use this box right here called current position, because like we said, working capital is the current assets, which is the first section, minus the current liabilities, which is the second section. Notice that in 1998, the numbers look very different than 1997 and 1996, and this is where Li Lu says we have to have encyclopedic knowledge of an industry. The reason why the receivables and the inventory is so much higher than the previous years is because this report was made in Q3, which in businesses like Timberland is very typical because they'll store up a lot of inventory and receivables for the holiday, and at the end of the year, they'll probably look very similar to 1996 and 1997. So if we want to figure out the working capital, we should probably look at 1996 and 1997. I'm going to use 1996 because I think it helps demonstrate Li Lu's numbers after he simplifies them a little bit better. So if we look, we have about 100 million in cash, about 300 million in liquid assets, and about 100 million in current debt. So if we take the 100 million cash and add the 300 million in liquid assets and subtract 100 million in debt, we get a working capital of $300 million. Now, long-term debt is much simpler. I wish they all worked like this. It's right here. Long-term debt, $100 million. Now, fixed assets is probably the hardest, and that's because you really can't gather it from a value line report unless you do some algebra. Really, the best way is by looking at the 10K. So we're going to use the algebraic method just because we want to do everything through value line because that's kind of what Li Lu did. So in order to do that, we're going to have to take the book value, which on value line is read as the shareholders equity. And that's that $275 million that we said earlier, or the 300 million that Li Lu rounded up to. So let me just back out and we'll go into the formula that I have, where I said that book value is equal to working capital minus long-term debt plus fixed assets. We have everything but fixed assets, so we can rearrange the formula to be like this one. So if book value is 275 million and we subtract the working capital of 300 million and add the long-term debt of 100 million, it'll equal 75 million, which Li Lu rounds up to 100 million. So altogether, if we put it all together, the book value looks like this: 100 million in cash, 300 million in liquid assets, 100 million in current debt, 100 million in long-term debt, and 100 million in fixed assets. Except there's another way to look at this. What if you took the liquid assets and used it to pay off your current debt and your long-term debt? Another way of looking at this is just like this. They're very similar, and it's a method that's pretty complicated that I don't want to get into, so you just have to take my word for it, unfortunately, for now in this video. But essentially, Li Lu says this is the same as a business that has 100 million in cash, 100 million in liquid assets, 0 in current debt because we used liquid assets to pay off the current debt, $0 in long-term debt because again, we took the liquid assets and paid off the long-term debt, and 100 million in fixed assets. This is how Li Lu came to the conclusion that Timberland's book value was $300 million, broken up into the way it is. This box right here. Now that we have a more accurate book value, we can find a more accurate price to book ratio. To do that, we're just going to need the market cap, or the total price of the business. And to get that, you just take the price at which Li Lu was buying Timberland stock, which is around $28 to $30, multiply it by the number of shares they had, which was around 11.5 million, to get a market cap or total price of around $300 million. You take that $300 million, divide it by the book value of $300 million to get a more accurate price to book ratio of 1, which Li Lu says is really great. Now for Timberland's earnings and my big reveal. Li Lu says to measure how much a business makes, you want to use operating income, which is how much the business makes before interest and taxes. To do this on value line, you just take the revenue or the sales and multiply it by the operating margin. Sounds simple, right? No. Li Lu is actually using a different kind of metric. He's figuring out how much the business makes before interest taxes, depreciation, and amortization. It's a different metric called EBITDA, and I can prove it.
What?
So we need to figure out operating margin, which is operating income divided by revenues. According to Value Line, Timberland's 1997 operating margin is 13.1%. To fact check this, we're going to need to go into Timberland's 1997 10K, which I found for everybody. If we go to the income statement, we can find that operating income was $83,853,000. If we divide that by the revenues of $796,458,000, we get an operating margin of only 10.5%. So clearly, Value Line isn't showing us operating margin, right? So here's what we do next. We go into the statement of cash flows and we find the depreciation and amortization of around $20,292,000. If we take the depreciation and amortization and add it to the operating income and then divide by revenues, that's when we get the 13.1% that Value Line shows. So yeah, Value Line isn't showing us operating margin. They're actually showing us EBITDA margin. Now, I don't know if it's just me geeking out about this or not, but I find it hilarious and a little bit ironic that Li Lu's top secret formula involves the use of EBITDA, a metric that his mentor, Charlie Munger, had this to say about.
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
And there's one more thing. Throughout the entire lecture, Li Lu repeatedly said that value investors have to have accurate and complete information.
You want to provide accurate and complete information. Accurate and complete.
I was really excited to bring this to you because I feel like there are a lot of great lessons to take away from it. The first of which is that we should probably go directly to the source with our information. But I think it also emphasizes what Li Lu was talking about earlier and the concept of a margin of safety. Yes, Li Lu used EBITDA for this example, or at least he did for the demonstration. But because his margin of safety was so wide, it allowed him to avoid some of the pitfalls of using EBITDA that Warren Buffett and Charlie Munger are always reminding us about. Then there's also the fact that our analysis can never be perfect, and there's always going to be something that we don't know. I mean, I'm sure there are a ton of other lessons to take away from it, but I think you get the point, and we'll just move on. So now that we have the company's pre-tax earnings, which in this case is Timberland's EBITDA, we divide it by how much capital is deployed into the business to get a metric he calls a return on deployed capital. Except, to my knowledge, there's no such thing as deployed capital.
That's a made-up word.
Who was made up?
Regardless of the term that's used, Li Lu wants people to take the pre-tax unleveraged earnings of a business and divide it by the capital deployed in the business to generate a profit. We already have the pre-tax unleveraged earnings. It's the EBITDA that we discovered earlier. What we need to figure out is what's the deployed capital. If we remember from earlier, the book value, and therefore what's used in the business, was made up of $100 million in cash, liquid assets, and fixed assets. So how much of that is actually deployed in the business to generate a profit? And that brings up an interesting debate in investing. Does that cash, that $100 million in cash, actually count as capital deployed in the business to generate a profit? It is cash just sitting idly after all. So in the description, I have a link to an article that I think discusses well the perspectives of both sides, using cash as deployed capital and not. Li Lu in this instance decides to ignore cash, meaning that deployed capital in this instance is $200 million, $100 million in liquid assets and $100 million in fixed assets. In summary, this is Li Lu's top secret investing formula. You take EBITDA divided by working capital minus long-term debt plus fixed assets minus cash. In the case of Timberland, it came out to $100 million divided by $200 million for a return on deployed capital of 50%. Now, I feel a little bit silly projecting this as Li Lu's top secret formula because it's not what he intended. It's just what it happened to be in this case. So in my perspective, Li Lu's top secret investing formula is really operating income divided by book value minus cash, or simply deployed capital. His metric, return on deployed capital, is how he measures the quality of a business. But that's all I have for you in the Timberland example. From there, Li Lu walks through his investing checklist, asking, is it cheap? Is it a good business? Is management great? And what did I miss? I have nothing to add to those points, so we'll just move into the next example in the Columbia 2006 lecture. Our next example is Li Lu's purchase of stock in a company called Hyundai department store H&S. So let's walk through this investment, starting with the first question he asks, which so happens to be the hardest question, lucky us.
So give me, what is the market cap?
So the first question we're asked is, what is the market cap of Hyundai department stores? According to Li Lu, it's $60 million because he took the price at the time and multiplied it by the shares outstanding.
Roughly about $12 roughly about what, 5.5 million shares? 5.5 million, okay, so $60-some million.
In the clips you just watched, Li Lu said the stock price traded around $12 and the amount of shares outstanding was around 5.5 million. This brings us to a market cap of around $60 million US. So now let's fact check that with the information and the documents we're given. To find the shares outstanding, you look in the top right corner and it'll tell you about 5.5 million, just like he said. However, I cannot find $12 as a stock price. We have some conflicting evidence. For example, if we look in the top left corner, we can see a table that shows us the low and the high of the stock price every single year. Li Lu is purchasing Hyundai department stores in 2005 when it was trading between 17,500 won and 46,500 won. To convert won to US dollars is pretty simple. You just divide by 1,000. So if we knock off the last 3 digits of both of those numbers, we get a stock price that traded between $17 and $46. This is reciprocated by the table on the right-hand side. The stock at the beginning of 2005 was trading around $20, and the stock at the end of 2005, or really June 2005, was trading around $45. This is also mirrored by the Bloomberg printout he gave us. If you look at the beginning of 2005, again, it was trading at around $20, and if you look at June 2005, it was trading around $46. So clearly something's off. So what's going on there? Later in the video, we find out that Hyundai department store had stock in another company. My guess is that Hyundai department store was trading around $22, just like our documents say, and that the company we own stock in was trading around $12, and Li Lu just confused them.
Okay, so I'll have 2 charts that are printed out directly from Bloomberg. One is that that department store. It was traded around somewhere around 22. Last I checked, it went to about 100. And then this one, start with 12. Last I checked, it's around 70 something.
It could also be that he messed up like he did with the Timberland example and gave us a report that was later than when he actually purchased it. Regardless, I'm going to do the math for both $12 and $22 and allow you to be the judge of what you think is right. So if you take the price of $12 or $22 and multiply it by the shares outstanding of 5.5 million, you get a market cap that's either $60 million or $120 million, respectively. The next thing Li Lu asks the students to consider is how much the company is making. To do that, we'll need to look at the bottom right corner of the document we're given in the income statement summary table. Keep in mind that all the figures in this table are in 100 million won units, and to convert to millions of US dollars, we'll just need to take any figure in this table and divide by 10. So now let's consider the 2 metrics Li Lu suggests we use for the earnings of this company, and that is net income and ordinary income. Typically, we want to use the most current numbers, which would be 2005. But because this report was in June 2005, we don't get a full year's worth of information. So we're not going to use June 2005. Instead, we'll look at December 2003 and 2004 as their full year figures. So first, let's look at net income. In 2003 and 2004, we made 24 million US dollars. And for ordinary income, it was around $31 million. These are the figures we'll use for the earnings of Hyundai department store. Lastly, we need to figure out the deployed capital so we can get Li Lu's return on deployed capital. To start, we're going to need to figure out the book value and then ask ourselves what's actually in the book value and go line item by line item to see what the true value is in that book value. So to do that, we're going to need to take the document we're provided, look in the bottom left-hand corner for the balance sheet summary table, and start with the shareholders equity, which is another name for book value. Li Lu uses the 2003 figures, so that's what we'll use too. In 2003, the book value was about $230 million. Remember from earlier in this video that book value is broken up into 3 components: working capital, long-term debt, and fixed assets. So we're going to break down each component and see what the true value is there. So working capital we get from taking current assets and subtracting current liabilities and getting $70 million. According to Li Lu, this is a fair valuation because most of it's in cash and marketable securities. Then we move into long-term liabilities. Li Lu says it's so small it's negligible, but I'm going to include it because it's going to make the math look great. I'm going to round up to $20 million. Again, you can choose to ignore this or not. It's really up to you. Then we look at fixed assets. Fixed assets is around 180 million US dollars. We have to ask ourselves, what's in this $180 million? And I broke down what is included in that $180 million according to Li Lu and his look at the financial statements. Of that $180 million, $30 million is book value of a hotel that Hyundai department store owns 100% of. Another $30 million is book value of a department store they own 13% of. It's actually stock in another company. And when Li Lu looked at the stock, It's actually very undervalued. It's like trading at 2 to 3 times earnings or something like this. So he said of that $30 million, it's probably trading closer to, I don't know, $80 million, even very conservatively estimated. So we'll put $80 million there. So then he looks at the rest of the $120 million, which he says is in real estate and ownership in 3 cable companies. He believes it's actually worth way more, but he'll take it at $150 million, again, just to be safe. So he wraps up everything and says, okay, so if I want to buy this stock and it's trading at $12, and like we said earlier, it could also be trading at $22, and this is where you can decide whether you think it should be 12 or 22, and you were to buy the entire company, you're going to pay either $60 million at $12 a share or $120 million at $22 a share. And this is what you're going to get in return. You're going to get $70 million in cash, $20 million in debt, $30 million of a hotel, about $80 million of stock in a company, and $150 million in real estate. If you total all this up, you're going to get about 310, we'll round up to $350 million worth of value. Of this $350 million worth of value, you're also going to make, if we remember from earlier, $31 million in pre-tax earnings. That is a great business. So that's a pretty good return on deployed capital. And it was enough for Lilu to want to invest in the company after running through the rest of his checklist and visiting the other sites to make sure that the value was truly there. However, now that we've seen 2 examples of Lilu creating this return on deployed capital, I kind of want to change our formula around. And instead of using operating income, because it doesn't include for non-operating income, I would use owner's earnings or just simply EBIT, earnings before interest and taxes. Whatever you use as a term doesn't matter as long as you get the concept right. And that's the earnings that the business itself makes before interest and taxes will be the best representation of how well your company's performing. So what are the results of Lilu's work?
Each went up about 5-6 times.
Those are some awesome results for a process that seems so straightforward. But as Lilu indicated, it'll only come to those hardwired and willing to do the tremendous work that's required. And if it doesn't seem straightforward, that's okay. We actually plan on making a YouTube Shorts video that'll take the entire analysis we did and remove all the fluff and extra detail and make it into a nice, easy to understand and simple process. So you can see how Lilu does it in short time. Also, we plan on including in the description some stocks that I found running a quick filter for anything that kind of matched Timberland stock. So that way you can run the exercise if you want to practice it. Also, we might even make a series where we run through Lilu's entire process from the beginning where we read every value line report to the very end when we do a scuttlebutt and visit the companies. If you'd like to see something like that, let us know in the comments section. Also in the comment section and in the description is going to be any source or reference that we mentioned throughout the entire video, as well as any corrections because we could always be wrong. So please make sure to always do your own due diligence. But that concludes our 3-part series of our review of Lilu's book, Civilization, Modernization, Value Investment in China. It's been an absolute joy and we really appreciate you staying till the end. If you don't know what I'm talking about, look in the description or click on one of these videos so that you can watch our review of Lilu's book. Thank you, and until next time.